Bitcoin's recent dip sparks debate. Is this a temporary setback or a signal of bigger shifts? Picture this. Bitcoin surges to a record 124,474, only to retreat sharply within days. While some see this as a classic correction, others argue it's a calculated move by institutional players. But here's where it gets tricky. The real story lies in the hidden mechanics of liquidity zones and open interest, which could either confirm a bullish rebound or hint at deeper instability. Let's break it down. Traders are cashing in gains as Bitcoin approaches its upper price boundaries, a pattern as old as the market itself. When assets hit new highs, it's natural for short-term holders to lock in profits. Yet this time feels different. Bitwise's Andrei Dragosh, a leading voice in crypto research, noted that while profit-taking is happening, the volume has been shrinking over time. That's a subtle but critical clue. Sellers are losing momentum. But here's where it gets controversial. Could this be a smokescreen? Are we witnessing a coordinated effort to test the market's resolve before the next leg higher? Meanwhile, Bitcoin's drop below $115,000 has sparked debates about its next move. Hyblock Subvarma, whose insights often split the crypto community, highlights a fascinating dynamic. He explains that liquidity pools, those invisible clusters of buy-sell orders, acted as a magnet during the weekend. As markets closed on Friday, these zones were swept, meaning orders were executed rapidly. Think of it like a dam bursting. Once the liquidity is drained, price can plunge. But this isn't just a technicality. Varma points out that institutional demand stayed strong during weekdays, with major firms snapping up BTC and ETH despite the chaos. The catch? Weekends are a different beast. When Wall Street clocks out, so does a chunk of institutional activity, leaving the market vulnerable to imbalances. Slippage spiked, bid-ask spreads turned bearish, and suddenly the $115,000 level became a battleground. Now, here's the twist. Open interest, a measure of active positions, exploded at the exact moment liquidity vanished. This isn't just a coincidence. Varma argues that this surge in open interest acts as a support zone, where both buyers and sellers are trapped. If Bitcoin stabilizes here, bulls could regain control. But what if it breaks below? That's the question keeping traders awake. And this is the part most people miss. The real action isn't just in price, but in the invisible tug-of-war between liquidity and leverage. Large Ethereum unstaking events are flooding the market with supply, yet institutional demand remains insatiable. It's a classic game of cat and mouse. So where does this leave us? Bitcoin's $115,000 level is now a psychological and technical fulcrum. Will it hold? Or is this the start of a deeper correction? The data tells a mixed story. On one hand, the sell-off was swift and sharp. On the other, the rebound in open interest suggests buyers are circling. But here's the million-dollar question. Is this a textbook consolidation phase or a warning shot from the bears? This article isn't financial advice. The crypto market is volatile, and every decision carries risk. What do you think? Is Bitcoin's recent dip a buying opportunity or a red flag? Drop your thoughts in the comments. Let's debate it out.